January FOMC meetings, I thought there would be a pretty good chance you would dissent, but you didn't. And in March, your objection was against the forward guidance changes and not the decision to continue tapering the bond purchases. So I'm wondering, why were you not opposed to continuing tapering? I was thinking that the act of tapering on its own is a signal that the Fed believes a recovery that we have now is good.
Yeah, I viewed the decision about tapering in December, so the decision to initiate the taper. I saw that as a decision that was made by the committee at that point in time to reduce the flow of purchases at each meeting by $10 billion, barring large changes in the outlook either way. That was a decision that was reached in December. It's not my intention to relitigate past decisions, and so that's the way I've been thinking about that.
So in the answer to the question of, well, what more should be done, we mentioned lowering the rate on excess reserves. That doesn't really sound like much. Could you explain a little bit more why that would really do anything? And I thought that was kind of off the table anyway. Are people really talking about that now?
Well, I guess I just did. No, I think the key is for us to be able to demonstrate in an effective fashion that we're committed to the recovery. I mentioned that as one possibility. I think there's possibly changes in language as well we could adopt in the statement that would be powerful in terms of demonstrating a stronger commitment to the recovery, and in terms of being willing to stay accommodative for as long as it takes to see the recovery to completion.
What about the idea, though, that the considerable time lag between ending the bond buying and potentially raising rates could be only just 6 months? I mean, is that the right time frame, or should you say more about that?
Yeah, I think we'd be better off describing more. Clearly, that and the chair went on to say when she was answering, I think, your question about this, that really it depends, right? It depends on the evolution of economic conditions, and I think we'd be better off having more of a collective vision as a committee of what that change in conditions would have to be that would lead us to go from ending the asset purchase program to raising rates. Then I think if we describe conditionality sufficiently, it becomes on market participants then to figure out how long that's going to be, and their own forecasts of the evolution of the economy can then feed into our policies automatically. So it would be great if we could communicate more effectively about, as a committee, as a collective, about what we see as the conditions that are going to affect that time horizon.
So just to go back so I understand correctly, if I understand, you're looking for ways to assure the public that you're going to see this through to the end, but you don't see taper as a good way to do that reassurance. You see the Fed funds rate, the excess reserves, the language.
The taper was a decision that was reached in December, and the committee is following through on that in terms of the communication about that, which was it was going to follow. As far as I understood that the decision at the time, and it's certainly the following 2 meetings have been consistent with that, going to continue to reduce the asset purchase program by $10 billion per meeting, as long as the outlook does not change substantially.
You talked about how weak demand is despite everything that the Fed is doing. There was a time a couple of years back when you raised the question, well, this is kind of as good as it's going to get. So I mean, how is what the Fed's doing helping at this point?
I think it's helping in a number of ways. I think having rates as low as they are continues to be a source of stimulus for our housing market, a source of stimulus for it puts upward pressure on housing prices, on asset prices more generally. Putting upward pressure on housing prices, how big that is, I think, it's certainly could be a subject of academic debate, but I think there's definitely an upward force on housing prices from our continued low interest rate policies. More generally, I think that when you keep interest rates low, that's a source of stimulus for spending. I think inflation, it's always a counterfactual in macroeconomics. And the counterfactual is that if we had higher interest rate policies in place, and we're not providing the kind of stimulus we're providing, employment would be lower and inflation would be lower as well. So we'd be falling even further short of our goals.
But the main way that we're seeing a positive impact might be in the housing market then?
I think it flows through it. The problem is that policy flows through a number of different ways. The general force of policy is to say that by making interest rates low, it makes saving unattractive for both households and businesses, makes spending more attractive. And that one way that shows up is by driving up housing prices, but another way it shows up is it makes car loans cheaper to get. So there's a number of ways that affects households in order to stimulate spending.
So obviously not a ton of that spending is going on, but you're saying it would be even worse absent this support.
Yeah, I mean, I think the short answer to that is yeah. We've seen growth. We've seen improvement in the labor market. I didn't talk about growth in my presentation today, but talk about improvement in the labor market. We have seen improvement in the labor market. It's really a question, and I forecast continued improvement in the labor market. It's a question of the speed of recovery, not about whether or not we're seeing a recovery. And I think that the fact that we've seen as much as we have has certainly been facilitated by Federal Reserve stimulus.
I also just wanted to clarify something. You said that we would be better off having a more collective vision as a committee about what the changing conditions would be.
Yeah.
So does that mean that there is no current collective vision, or were you talking about communicating the collective vision? I mean, I think there's a distinction there that's actually quite meaningful.
I won't draw maybe as sharp a distinction in my mind as you would. I think it's important for us to formulate and communicate a collective vision. I think the act of communication, I think there is a vision of in general that we want to have price stability and maximum employment. Those are goals that we share in common. Our long-run goals statement is another vision that we share in common. But I guess I'm of an opinion that unless you communicate that to the public as a whole, it's not playing as much of a role as it could. Unless we communicate as a group about what those conditions are, then we face this instability that 2 words at a press conference or 2 words in a speech or an answer to a senator can end up moving people's the financial market participants' vision of what we're trying to do with policy. Unless we communicate more effectively on a collective basis about how conditions are shaping our policy choices, I think we're going to continue to face that kind of instability. Yeah.
Just to bring things down to a local level really quickly, I know before you had to talk here, you met with some local leaders from Mayo as well as business leaders. I was curious to kind of what they were looking for from you, and maybe your take on Rochester, just briefly, and where things stand here.
So when I meet with business leaders, and I do this around the district, one of my jobs is to participate in FOMC meetings, as I described in my speech. And what I take forward to those meetings, in part, is communication about local economic conditions. The reason I do that is, obviously we're not going to make monetary policy based on what's happening in Rochester. But what's happening in Rochester, what we learn from our local business contacts, is a way for us to try to formulate a vision of what's going to be coming around the corner. So our aggregate data is often lagging, it looks backwards in time. We need ways to look forwards in time. And so I wanted to, this is a economically robust area, wanted to talk to local business leaders about what's going on here. Certainly, I got what I took away was certainly a lot of confidence in what's happening here in Rochester.
I have a question on that.
Sure.
I'm Karen from Market News International. My question is, what are your thoughts on the reverse repo facility being tested by the New York Fed, and do you see it having a role in policy going forward?
I think it's good to test out various kinds of tools. I'm happy that they're doing that work, and obviously the decisions about what role it should have in policy going forward would depend on the outcomes of those tests.
When you say that you have no intention to relitigate decisions that have already been made, does that no intention to dissent against the April FOMC statement, even if the language around the forward guidance doesn't become more specific, like you've been calling today?
I think, again, I think that's a good question. My decision to dissent will be made on a meeting-by-meeting basis, but I did view what happened in March as a significant change in communication. I think the committee was laying out communication that it was hoping would be sufficiently robust to last for some period of time to come, certainly longer than March to April. And so I don't foresee dissenting on that basis alone. It would depend, whether or not I dissent then will depend on the evolution of the outlook, the evolution of the conditions, and how the committee is thinking about those changes, and how my own thinking is on that.
Could you talk a bit about the path of rates that you would see as appropriate?
I get that question a lot, and I don't know if I'm going to say it's not the right question, because I think really at the end of the day, policy is not about me. It's about the committee. And I think when I answer that question, I worry that I distract from what really should be the real question, which is not even about the path of interest rates for the committee. It's really about how the committee is planning to react to the evolution of economic conditions. Because the projected path over the next 6 months or a year and a half or 2 years or whatever it is going to change depending on what the evolution of economic conditions is. So I'm not going to talk about that.
Okay, so let me rephrase the question. In terms of conditions, in terms of formulating a vision about the kind of conditions that would, what can you say about moving beyond your 5.5% threshold, which I understand if you're not going to relitigate, I would imagine you wouldn't relitigate that. Or maybe you will. What kind of, how would you
I think there, again, I indicated after my dissent the kinds of conditionality I would have preferred the committee to offer. The committee chose not to go that route, going a different direction. I look forward to working with my colleagues to working on this problem of figuring out what the right collective approach is and communicating that as best we can. The benefit, and when I dissented, I didn't stress this. The benefit of the language the committee offered by way of forward guidance is it provides flexibility. And provides the committee with flexibility to respond on an ongoing basis to the evolution of conditions. I think it's going to be honest now to talk about how we're going to use that flexibility and try to communicate about our uses of that going forward. I'm not. Again, I think it's really more about the collective decision making and our need to communicate about that more than my communicating about what Narayana Kocherlakota thinks about the conditions.
Can I get a little clarification on why is the 5.5% unemployment? Why is that the threshold that you're setting now? And should it be perhaps something more about once the number of long-term unemployed in America gets down to a certain threshold or something like that? I mean, given how big a problem that is, Kruger saying those people aren't even going to get back into the workforce. We'll talk a little bit about that threshold.
I think you've raised, that's a great question about. So there's two pieces to your question. One is, why do we use the unemployment rate, or why did I suggest we use it first of all with the guidance that we offered in December 2012, and then I was suggesting going back to it. And I think the unemployment rate, the reason to use it is it's a very familiar and a marker for most Americans about the health of the labor market. It's the way we've always communicated to Congress about how we're doing. It's the primary way we communicate to Americans about how we're doing. It's really the best way that we can offer accountability is in terms of that rate. It's when we talk about what is the long-run health of the labor market that's consistent with 2% inflation, we offer that measure in terms of the unemployment rate. And so the metric that, why do I choose 5.5%? It's because it's in the range of estimates, right in the middle, maybe a little bit higher in the middle now, of estimates of unemployment rates that the committee has offered has been consistent over the longer run, has been consistent with 2% inflation. I think that range is between 5.2 and 5.6% right now. So 5.5 is a good measure, I think, of being back at maximum employment.
there wasn't much conversation today about kind of how you see the economy. I mean, we had a jobs report last week. We've had some pretty severe weather up in this area throughout the winter. Do you have a current GDP outlook, or has that changed at all? What is your current thinking on the state of the U.S. economy?
Yeah, I don't think my outlook has changed materially since the beginning of the year. Certainly, we've had some weather issues. I face the same problem as everyone else of trying to sort out how material those have been, as opposed to hiding some true strength in the economy or hiding some weakness that we don't know. It's definitely made life challenging for us along those regards. I wouldn't say that my outlook has changed materially from the beginning of the year.
What your outlook at the beginning of the year, if you could just remind us, please?
Yeah, so seeing growth, maybe around 3% during the course of 2014. And then, unemployment rate falling into the low sixes by the end of 2014.
Getting back to the long-term unemployment question, I know you've said that one way to deal with long-term unemployment is to have fewer people crossing that threshold from the recently unemployed and then falling into longer-term unemployment. But for those who have been kind of stuck in that category for a really long time, do you believe that if the economy did just kind of get enough juice going and the demand were stronger, that we would see those people come back into the labor market? Or are they?
I think we paint things very black and white in a way that's, I think, inappropriate. I mean, first of all, people do exit out of long-term unemployment into finding jobs. I mean, even we talked about Alan Kruger's study that he presented at Brookings, that those transitions do take place. So I think it's really about what would be the rate of inflation that would be associated with a much higher exit rate from long-term unemployment into employment. And I think it's unclear at this stage. I don't know the answer to that. What I will say is we can do better. That's the theme that I was offering today. The fact that inflation is as low as it is tells you that there's room for improvement on, and it would be improvement on every dimension. How much it would be on this particular dimension, I think, is harder to know.
Governor Stein announced his resignation, and as you know, he's been a very vocal advocate for using monetary policy at times for financial stability goals, even if it means accepting a higher unemployment rate for some time. And I remember back in the fall we talked about this, and your views were that using interest rates to prevent a pop bubble is not a good use for monetary policy. I was wondering if your views have changed since then.
Not so much that it would matter for the course of monetary policy or the near term. I gave a discussion in New York at the end of February where I talked about a framework for thinking about monetary policy in the context of financial stability. I guess I gave a similar talk in Washington in March as well. And the punchline of that analysis was that I think there are reasons to be thinking about the impact of monetary policy on financial stability. That impact can be both positive, that is, low rates can actually lead to more financial stability, but it could also be adverse for financial stability. But at this point in time, you have to see that translate into your forecast and really the risks to your forecast for unemployment and inflation. And I just don't see those risks as being sufficiently material at this point in time to be a consideration. When we're back to, I think the issue is when we get back to maximum employment or much closer to maximum employment, and when inflation is much closer to target, I think these considerations are ones that certainly could well be ones that we should be talking about. Those risks should start to matter then in terms of relative to where we're going with policy.
I mean, the fact that you added sort of the financial stability caveat to your formulation of policy suggests that is it because you think that by the time you get close to that that's when it is, or have you become indeed more concerned about financial stability?
No, it's more a reflection that it's just a guardrail. I viewed the 2.25% that I had in there as a guardrail as well. It wasn't that I thought we were going to get to 2.25% inflation. The concerns I've heard, look, I suggested you can take the meat of that proposal as saying, I was suggesting keeping the Fed funds rate extraordinarily low, at least until the unemployment rate hits 5.5%. What's the downside of that? You can create inflation. Okay, so we put a safeguard for that. And then others have offered the possibility it could create financial instability. So we put a safeguard for that. So that's the way, but I view those as guardrails and not, I never thought in the Evans rule that the 2.5% was a threshold, because I think we're going to never get close to that. So it was really more of a guardrail to deal with a contingency that I viewed as very remote.
When the FOMC minutes come out tomorrow, will there be any surprises with respect to any?
I don't know. I don't know your baseline expectations, so you'll have to wait and see. No, I mean,
you pretty much articulated what your main.
Oh, I think that. No, I've tried from my own contributions. For my own contributions, I believe that the minutes will not contain any surprises.
I did want to ask, sort of related to Stein's leaving the board. We've seen, it's not up to the full levels yet, especially with the nominations still pending. How does that affect policymaking? Do you worry about it? Should it be a high priority?
Oh, I believe it should be a high priority for the President and Congress to staff the Board of Governors of the Federal Reserve System. It's an incredibly important position. I think it enhances our monetary policy deliberations. Governor Stein and I didn't agree on every issue, but he was an incredible intellectual force in the committee, and I think the nominees that have been brought forward by the administration would also add a lot to our deliberations. Beyond that, the Board of Governors oversees the whole Federal Reserve System in the United States. I would think that the Congress and the President would want to have that up to full speed in order to be able to do that job in the most effective way. So I feel very strongly that, that should be staffed.
It's Warren Spring, and I'm in a good mood. One more question. Is that it?
Okay.
Oh,
Okay.
Sure.
Okay.
Okay. I guess the one wrap up I would have is, do you think the markets, the public needs a convincing that the Fed's committed? That seemed to be the thrust of your comments here, and you seem to be truly concerned about this. And I'd be curious what is giving you that indication, or why you think a convincing or to the commitment is needed.
Yeah, I think that's a good question. I just look at and I'll focus on inflation. I look at the fact that we've been missing our target for as long as we have. And my forecast is that we're going to continue to miss our target for a long time to come. And I worry about erosion of I think the chair gave a great, eloquent. She did as much as words can to say that we're committed. But I think the way you really build up that belief in your commitment to hitting the target is through actions, and actions meaning collective actions embodied in the statement.
Well, I was just wondering, I think before Chairwoman Yellen took over, you had suggested that she was someone who was going to be pretty good at communicating about this thing, and so are you about in terms of quantitative measures rather than qualitative?
Oh,
are you
so
disappointed that she?
I think the decisions are a joint one. Those are committee decisions, and the committee has reached a decision to go with a more qualitative form of guidance. That's I ask sometimes why did you dissent? And it's really to tell people you lost. It's really an open admission, honest admission of defeat. And so we had a long discussion in the committee. I was pretty open for a long time, as some of you know, about wanting to have more quantitative metrics, markers and the committee decided to go a different way. This is not about who's chair of the committee. It's about a committee decision.